is the managing partner from Westwood Capital to talk about the year in equities and some emerging markets. Dan, welcome to Rise Exchange. Thank you for stopping by. So, how much did the market surprise you this year when you talk about equities?
I think the disconnect between the bond market and the equity market was a little surprising. After all, I was one of the few people at the end of last year who went on camera and said, bond rates are going to go down. U.S. Treasury rates are going to go down. Everybody a year ago expected them to go up.
Sure.
And in that environment, of course, we saw the market behave as though there was more free lunch coming, more liquidity, and therefore fewer opportunities for alternative investment in bonds. And so a lot of money moved into equities.
Did we get that free lunch, basically?
Well,
more so than you thought?
We did, except for the fact that everybody thought at the time that with the Fed tapering off of purchases, we would end up in the opposite situation. So it's very interesting. Are the markets in a safe place at this level? I'm not so sure.
Yeah.
I think that a lot of the trading since the last real push has been at very, very low volumes, and I'm not quite sure that equity markets are going to be able to
that's true. We've been moving
week.
higher on low volumes, which is
Right.
usually a case. It's like the person goes into the store and buys things when the store is empty. You
Right.
can't really read too much into how that business is doing.
Right.
And you mentioned the Fed and interest rates. How do you think the Fed is able to keep rates low when it has ended this tapering program, or when it has tapered?
Well, I think the answer is that the Fed really wasn't the reason that rates were low to begin with, and I think that's what was proven this year beyond, in my opinion, beyond the shadow of a doubt. I'd been claiming that for a while, but the reason is we have a huge global capital glut. There's just too much cash chasing too few high-grade sovereign debt, too little high-grade sovereign debt, and that is creating a problem that is going to continue regardless of whether or not the central banks are buying.
We don't talk much about the bond market on this program, but let's do that right now. Do you think you're going to see a change in attitude with the bond market going forward into 2015?
Well, one would think, given the last couple of quarters of growth in the United States, that the bond market should be trading off and yields should be going higher. But as a practical matter, we're faced with this incredible and unprecedented onslaught of deflation, not just in Europe and Japan, but now in the United States, especially with the drop in oil. We're going to see prices deflate as they did last month, next month, the next month, and who knows from there. In a disinflationary environment, and especially in a deflationary environment, it's hard to imagine that interest rates can rise.
The Fed doesn't use that word deflation because
it's a dirty word. The D word.
It is a boogeyman word, right. Definitely. There's very little they can do to combat it, isn't there?
Well, this all gets back to the subject of the book that I wrote, which is called The Age of Oversupply. And I think the proof of the pudding is you go look at China, right? China is a market that's growing still very, very quickly. And you would think that its inflation rate would be quite healthy. Well, China, year over year, has fallen to 1.6%. I mean, that's below the Fed's target for the United States in a far lower growing economy. So it's very, very hard to imagine a world in which you have the fastest growing economy with price growth so low that you're going to be able to see price growth in the developed markets.
I want to talk about emerging markets for a moment. This was a very challenging year for many of the emerging markets, especially in sort of those BRICS nations, Brazil, Russia, India, China, South Africa. What do you see, what was the impact that emerging markets, why did they struggle so much?
Well, put aside India. India has a very good story right now with Modi having become prime minister and is now in a position, hopefully, to introduce the market liberalization that India so badly needs. Now, of course, not all of that is really great news for the United States or for the other developed markets, because if you unleash India the way China has been unleashed in terms of production, that's going to put a lot of competitive pressure on the developed world. But as a play in and of itself, I think India is very, very attractive. I think that, of course, Modi could slip up. A lot of it is, in fact, politics, not economics. But we will find out what happens next year. But certainly India had a great run. China had a run up at the end of the year, but I think one of the problems is that people don't recognize what's really going on there. They are in the process of liberalizing their onshore markets as opposed to offshore trading of stock in Hong Kong and what have you. And so you're now seeing an enormous amount of price escalation in anticipation of the fact that foreigners are going to be able to freely trade in those markets. So the China situation obviously was pretty bad for most of the year. Last 2 months, it went up. Everything else, pretty much everything else, when you consider Mexico and Russia, et cetera, it's all oil affected.
Well, I was about to say, commodities-based emerging markets, Brazil,
they're
Russia,
they're history, right? I mean, for now, they're history. I mean, look, as long as the Saudis continue to pump at the rate they are, as long as the U.S. continues to develop its domestic oil and gas industry at the rate we are, it's very difficult to imagine a situation where the secondary suppliers of energy are going to do very well. And of course, I'm lumping Russia in that category, which is a hell of a nerve, because it's hardly a secondary supplier. But you look at the evisceration to the Russian economy caused by the drop in oil, it's pretty dramatic.
Dan Alpert, thank you so much. Happy New Year.
Good to be here.
And coming up, we are going to talk about oil as Rise, Exchange, Rewind continues. Stay with us.